Hey guys, welcome back. In today's video, I want to talk about something that we were discussing in the chat room, and that is how to choose a good strike price when we're day trading options. Now, obviously, there's a lot of things that we do need to consider when we're choosing a strike price, and it is going to vary from one instrument to the next. So in this video, I'm going to break down kind of what I look for on trades when it comes to choosing a strike price, and hopefully this will help you guys out as well. I'm Tex. If you're new here, I share my journey and experiences with trading and investing in the stock market. Thanks a lot for watching. Let's get started. Okay guys, so I know when it comes to choosing a good strike price, it can be really confusing, and one of the most common mistakes we see beginners make is choosing a strike that's really far out of the money simply because those premiums are cheap. Now obviously when we're trading options, it's not as simple as trading the stock where we can simply buy or sell shares of the stock. We have to actually choose an expiration date and a strike price before we can ever execute a trade. Now most of the time we're trading weekly expirations, which means that the contracts expire at the end of the week on Friday. So first thing that I really need to ask myself before I choose a strike price is what day of the week is it? Now, generally speaking, if it's a Monday, Tuesday, or Wednesday, it's going to be a little bit safer to choose a strike price that's a little out of the money. But when you start getting toward the end of the week when those contracts expire on a Thursday and especially on a Friday, I'm generally always going in the money or at least at the money. It is much safer to do that than to try to go out of the money, because what's going to happen is as you get closer to expiration, especially on the day of expiration, those contracts become very sensitive to any price movements in the underlying that they're tracking. So you can get yourself in a situation where the premiums never really recover and you can end up losing significantly on your position, if not your entire investment. So it's very, very important to always take that into consideration. As we know, time decay is a major factor impacting the premiums of those contracts, and it becomes even more exaggerated toward the end of the week by Thursday and especially Friday. So when we take a look at this trade that I executed on the SPY, this is one of my bread and butter trades, basically a counter trend trade, looking for something that's overextended and just due for some type of a relief bounce. And you can see on the SPY here, we had this nice little volatile sell-off. And what I do on a trade like this is I'm taking advantage of a rapid decrease in the premiums of, in this case, calls, in order to capitalize from that and get a quick scalp trade out of it. And one of the beautiful things about options is that because volatility is one of the biggest driving factors of the premiums on those contracts, you will often see when you get a move like this, the premiums deflate so much because they're going through rapid price discovery. In other words, the buyers just completely fall off the bid on those calls. They no longer are interested in buying the calls as the stock is plummeting lower. So you can often get really good deals on the premiums that you can almost instantly turn around for a profit. But the key here is choosing a good strike price. So again, I ask myself, what day of the week is it? Today is actually a Thursday, and these contracts are set to expire at the end of the day tomorrow. So because it is toward the end of the week, I need to be very vigilant about choosing a strike price that is at least at the money, where a key technical level is that I'm basing my trade off of. So if we look at the chart here, we can see that I was obviously looking at this green dashed line that is marking the second support level from the pivot point indicator. If you're not familiar, I made a webinar discussing what the pivot point indicator is. I'll put a card at the top of the video. Feel free to go check that out. I explain it and give you a lot of details and examples about how you can use that. But I was noticing that the SPY, you can see it on the hourly chart here. Here's your pivot point to your second support level from the pivot point indicator. I was noticing this, the SPY on the 5-minute chart here had some nice extension with speed and distance moving away from your short-term moving averages, your 5 and your 9 EMA right there, as it's coming down into that support level from the pivot point indicator. So what I did is I'm watching the calls as it is coming down into that key technical level, and I'm looking to essentially execute a trade without waiting for confirmation. I'm executing a trade as the stock is coming into that key technical level. Now, obviously, this is a trade that requires, this speed and distance. It requires this extension to execute something like this. But with that extension, obviously comes volatility, and with volatility comes that rapid decrease in the calls, which is what we're looking on capitalizing from, that rapid price discovery, getting a really good deal, and then immediately turning it around for a profit. So how did I choose a strike price for this? Well, the key technical level that I'm looking at playing off of is right about $333.80. So the first thing I need to do is go and look at my option chain. You can see I have an option chain pulled up right here, and I start looking at strike prices that are right around that support level. Now, because it is Thursday, I know that I need to be trading something that is at the money or in the money. So I see here that there is actually a 334 strike, and that's basically right at the money. That's right at that technical indicator that I'm looking at basing my trade off of on the underlying chart. So I went with the 334 calls in this case. And the reason being is because that did give me a little bit of wiggle room. If it had come down sometimes, remember, these things don't always stop right on the level. Sometimes they'll stop a little before, sometimes they'll stop right on it, and sometimes they'll overshoot it. But given the right circumstances, given the extension with speed and distance away from your short-term moving averages, the odds favor that it will have some type of relief bounce, some type of interaction off that level that does provide a trading opportunity. So I went with the 334 strike because it does give me a little bit of wiggle room around that price level. It's not really far out of the money. For example, if I went with something like the 339 strike, that would be way up here. That is way far out of the money. So if I go with a 339 strike, then I'm going to need the SPY to, have a significant retrace to get any kind of real move in the premiums. It's not that you can't make money. It just means that there's probably not going to be a whole lot of buyers really interested in buying something that far out of the money when you have a stock that's literally going the opposite direction. Okay, so it's really important to choose a strike that is at the money or even safer in the money. I could have actually gone with something like the 333 strike, right? The 333 strike would have been 1 point in the money. It would have been a little bit lower. Now the premiums are going to be more expensive, obviously, because it is in the money more. But generally speaking, it's going to be safer, especially toward the end of the week. So on a Friday in particular, a lot of times I might even go 1 or 2 strikes in the money, not even at the money. I might go in the money. So it's really important to take that into consideration. What day of the week is it? Another really important thing to consider is the volume on the particular strike price that you're looking at. So on your options chain, you should have an option. You should have the ability to have a data field that shows you the current number of contracts traded on the day on a specific strike price. So we see on the call side, here is your volume, and the 334 calls traded just over 22,000 contracts on the day. That's a good amount of volume, right? But we are talking about the SPY. This is an ETF that tracks the S&P 500. This is a very, very liquid instrument. So it's a really great instrument for beginners to trade in that regard because it's extremely liquid. There is never a problem getting in and out of trades pretty much with any strike price that you choose that's even remotely close to the money. You can see the amount of volume traded on the call side, and on the put side is plenty of volume to have the liquidity necessary to get in and out of trades. However, if we start looking at other stocks, for example, Amazon, you'll notice that we look at the volume side here. Look at some of these contracts. This one right here, only 98 contracts were traded at that particular strike price. Okay, so what that means is there's not very much liquidity at that strike price. That is the 3165 calls. Okay, so the 3165 calls only traded 98 contracts today. So that tells me that there's not much liquidity in that strike price, which means that the spread between the bid and the ask, what the buyers are willing to buy and what the sellers are willing to part with their contracts for, is going to be pretty wide. Okay, and so the wider that spread is, obviously the more risk there is on the trade because you're most likely not going to be able to get in and out at the price point that you want. So really, really important to take into consideration the volume. It's also good to kind of see what the open interest is. This is telling you how many contracts are currently open at that particular strike price and expiration date. It's not overly important to pay attention to that. It's good to just kind of glance at it, I'd say, but I would put the most emphasis in volume. So when you start talking about trading other things that aren't as liquid as the SPY, for example, your Amazon, your Netflix, you see on Netflix, it closed at, or it's currently trading at $480 or so. So your 480 strike price here is at the money. And you'll notice that it traded only 508 contracts today. But if you go to the 500 strike price, which is 20 points out of the money for the calls, it traded 5,700 contracts. So there was substantially more volume traded in this case in calls that are substantially out of the money. So it is important to take into consideration what that volume is in order to choose a good strike price. But I would say that the closer to the end of the week that you get, just remember that it's going to be a lot more risky going with something that's quite a ways out of the money. You're going to need something that is a high probability trade, that it is going to make that move that you're looking for. Now, it doesn't have to come all the way to your strike price. For example, Netflix, I guess last price was $481.65. Okay, so it's roughly 20 points away from $500 a share. If you bought a 500 call, Netflix doesn't have to go all the way up to $500 a share for you to make money on that call, of course. But if it doesn't even get remotely close to that, if it barely moves above 481, you're just not going to realize much potential on that contract because it is so far out of the money. So just remember that the further out of the money you are, the more substantial the move is going to be required for the underlying to make in order for you to really get much out of the premium, especially toward the end of the week. So the reason I bring this up is because, for example, on the SPY trade, let's go back to our SPY option chain here. On this particular SPY trade where I bought into this 334 level, I went with the 334 calls. If I had gone with something really far out of the money, like the 339 calls, for example, that's way up here, and the SPY just had like a small little bounce and then just cratered from there, the premiums are going to lose even more value because it is now moving even further away from your strike price. So the strike price you picked in this case was already so far out of the money. If it doesn't work and it breaks that level of support that you're essentially basing your trade off of, the premiums are going to fall apart instantly on you. And so you can get yourself in a situation where essentially the premiums lose so much value that they never really recover and you never really get a chance to get out of the trade profitably. So choosing a good strike price that is at the money or in the money later in the week, closer to expiration, really important. Choosing a strike price that has enough liquidity for you to get in and out, paying very close attention to what the volume is also incredibly important. So try to weigh all of these factors in your decision making when it comes to choosing a good strike price. Again, this is all basically assuming we're trading the current week's expiration, which most of the time we are, but just always take that into consideration. Choosing a strike price simply because the premiums are really cheap is not usually something you want to pay attention to. The only time that I will really go far out of the money is on a stock like Amazon. So for example, last price traded on Amazon is $3,181 a share. So if we look at the 31.80 strike price, that's right about at the money, close enough. You can see the calls are $30 a contract. That's pretty expensive for just one contract. So a lot of times on a stock like Amazon, because the contracts are so expensive, I will go much further out of the money because I can afford a lot more contracts than when they're $30 a contract. But again, the risk of that is that you're going really far out of the money. So you need that high probability that the stock is going to put in a substantial move in your direction, essentially. So if I believe that Amazon's going to go higher, it's currently at 31.80. I might look at the 32.50 maybe. So Well, let's start with 3,200. So if you go up to 3,200, yeah, sorry, not 3,250, 3,200. If you look at the 3,200 strike price, the calls are $21 versus 3,180, $30. But just for grins, let's go, let's look at all prices, and let's go up to 3,250. So your 3,250, sorry, went too far. Here you go. So your 3,250 strike here is down to $8. Okay, but that is really far out of the money. That is, you know, substantially out of the money. What is that? 50, 60, 70, $70 out of the money. That's quite a move. It's, you know, Amazon is over $3,000 stock. It could certainly make that move, but the odds have to favor that it will make at least a large chunk of that move to make it worth the risk of taking something that far out of the money. So really, for that reason, I would recommend for beginners to not trade stocks as pricey as Amazon, because of the fact that you have to go so far out of the money to get contracts that are cheaper. And, you know, if you wanted to trade something at the money, the contracts are so expensive that, you know, you may not have the capital to really put on that kind of risk. So just take that into consideration. The instrument that you're trading is going to definitely play some part in choosing the strike price, but I'd say the most important consideration is how much time do you have till expiration, because of that time decay really being a lot more sensitive closer to the end of the week. And then also volume. Pay very close attention to what the volume is doing, especially on some of these stocks that have lower liquidity in the options compared to something like the SPY. SPY, Apple, AMD, Facebook are all generally very liquid options that you shouldn't have any problem getting in and out of. Amazon, Netflix, and here lately NVIDIA, you know, have been a little bit less liquid on the option side, so the spreads are wider. So all of these things, you know, you really have to take into consideration before you do execute a trade. If you have any questions, you know, let me know in the comments below. I know this is a little bit of a little bit more of a complex topic. I tried to explain it as simple as possible, but you know, it's just really hard to explain something that's relatively complex in a very simple fashion. At the end of the day, you've got to get the screen time in. You've got to watch these premiums move on these various strike prices, in the money, out of the money, at the money, and you'll kind of get an idea of how those premiums will move depending on the strike price that you're choosing. So hopefully it was helpful. I do appreciate it, guys. If you did find the video helpful, do me a favor, hit that like button. It really does help me out. I really appreciate it. As always, take care, and I will see you in the next one.